You're watching the tape. The price of a stock ticks along, orderly, predictable. 1,000 shares trade here, 500 there. Then, out of nowhere, a ghost print flies across the screen. 1,000,000 shares. A monster trade. But the price barely flinches. You stare, confused. If a whale that big just jumped into the pool, where's the splash? You just witnessed the biggest secret on Wall Street. The market you can see is only half the story. The real action, the trades that move billions, happens in the shadows, in a parallel financial universe designed to be invisible. Today, we're going through the side door. The quotes on your screen, the bids, the offers, the last price, feel like the entire game. It's the public square, the central arena where buyers and sellers meet. But it's not. On any given day in the U.S. market, a staggering 40 to 45% of all stock volume trades somewhere else entirely. That's nearly half of all activity happening away from the glare of the public exchanges like the NYSE or NASDAQ. This isn't a niche phenomenon. It's the structural bedrock of modern markets. There is the market that sets the price, and then there is the market that quietly gets the business done. The official story is simple. Exchanges are where prices are made. They consolidate all the buy and sell orders, and the price you see is the equilibrium point. The real mechanism is far more subtle. Think of the public price, the National Best Bid and Offer, or NBBO, as a giant illuminated billboard on a highway. It shows the best available price to buy or sell right now on a public road. But a huge portion of the traffic doesn't want to drive on that main road. They just look up at the billboard, note the price, and then execute their deal on a quiet, private side street. Seconds after the deal is done on that side street, a small notification is sent back to the main highway's traffic control. That's the ghost print you saw. It gets reported to the public tape, but the deal was already done. The price was already agreed upon, using the billboard as a reference. This means the ticker you're watching is often a rear-view mirror, not a windshield. It's telling you about a deal that's already in the history books, not one that's shaping the road ahead. But why build this elaborate system of side streets? The answer, as always, is about information and fear. This two-tiered world wasn't born overnight. It evolved. Back in the day, big institutions wanting to trade huge blocks without spooking the market did it upstairs, over the phone. It was a clubby, inefficient system. Then, in 1969, a company called Instinet launched the first electronic side door. It was a primitive computer network that let institutions whisper to each other electronically, matching buyers and sellers away from the shouting on the exchange floor. It was a revolution in stealth. The game was on. In 1987, a system called POSIT from ITG created a crossing network where institutions could submit their orders and, at specific times, the system would cross them anonymously at a single price. Then, in 2001, LiquidNet perfected the model for the biggest players. Its pitch was irresistible. Got 1,000,000 shares to sell? Don't drip it into the market and watch the price fall. Just park your intentions securely in our system. If a natural buyer for 1,000,000 shares appears, we'll introduce you. You'll trade silently at the midpoint, and no one on the outside will be the wiser until it's over. Each innovation was another step away from the public eye. Regulators weren't blind to this. They shaped it. Two key regulations poured the concrete for this modern structure. In 1998, Regulation ATS, for Alternative Trading System, created a formal legal framework for these private venues, including what we now call dark pools. It legitimized the side streets, as long as they followed certain rules. Then came the big one, Regulation NMS, passed in 2005 and implemented in 2007. It was designed to link all the exchanges together and guarantee investors the best price. But it had an ironic side effect. By cementing the NBBO as the universal reference price, it made it incredibly easy for dark pools to peg their trades to it. They could now get a reliable, free price feed from the public market and use it to conduct their private business. So let's be precise. A dark pool is a type of ATS, a private stock trading venue where orders are not displayed to the public. You can't see the order book. There's no visible depth. The primary goal is to hide trading intention to avoid market impact, the costly effect of your own order moving the price against you. Most trades in these pools happen at the midpoint of the public bid and offer. This offers both sides a sliver of price improvement. The buyer pays a half-penny less than the public offer, and the seller receives a half-penny more than the public bid. A small win-win in exchange for trading in the dark. Now here's a mistake almost everyone makes. They hear off-exchange and think it's all giant institutions and dark pools. That's not true. Of that 40+% of off-exchange volume, dark pools themselves only account for about 10 to 15% of the total market. The much larger slice of the shadow market is something else: internalization. This is where your own retail broker or a massive wholesaler they partner with simply fills your order themselves. One type of darkness is for institutional giants trying to hide. The other is for millions of retail investors whose orders never even try to reach an exchange in the first place. When you hit buy on 100 shares of a popular stock, you might imagine your order flying to the floor of the New York Stock Exchange. It almost certainly doesn't. Instead, your broker, through a practice called payment for order flow, sells your order to a giant wholesaling firm like Citadel Securities or Virtu. The wholesaler pays your broker for the right to trade against you. Why? Because your order is considered uninformed. You're not a hedge fund that just discovered a secret. You're predictable. By seeing millions of these small orders, they can profit by capturing the tiny bid-ask spread, filling your order instantly from their own inventory, often giving you a fraction of a cent better than the public quote as price improvement, and pocketing the rest. For institutions, the problem is the opposite. Their orders are too informed and far too big. A block trade is typically defined as at least 10,000 shares or $200,000 in value. Imagine you need to buy 1 million shares. If you just dump that order on the public market, you'll walk the book. You'll buy up all the shares offered at the current best price, then the next best, then the next. You become the shark that everyone can see, and the price runs away from you. Your own buying activity becomes your worst enemy, a phenomenon traders call information leakage. So, how does that million-share buy order get done? Through a sophisticated algorithmic dance. The portfolio manager's algorithm first slices the giant parent order into hundreds of tiny child orders. Then it goes hunting in the dark. It sends out feelers, known as indications of interest, or IOIs, into various dark pools. These are non-committal pings, just asking, anyone out there have size to sell? The algorithm might use conditional orders that only become firm if a matching seller is found. It probes for liquidity silently, trying to execute as much as possible at the midpoint, away from public view. Only the leftover, residual shares that couldn't find a match in the dark are then carefully dripped onto the lit exchanges. This world of private venues and hidden orders is built on trust. But sometimes, that trust is broken. In 2016, the dark pool industry was rocked by scandal. Barclays was forced to pay $70 million to the SEC and the New York Attorney General. The reason? They had marketed their dark pool, LX, as a safe harbor, a clean, well-lit place where institutions could be protected from predatory, high-frequency traders. But investigators found that Barclays was secretly inviting those very predators in, giving them advantages, and routing its own proprietary flow there. Around the same time, Credit Suisse paid over $84 million to settle similar claims about its Crossfinder pool. The watchmen were letting wolves into the sheep pen. This climate of mistrust helped fuel a rebellion. A team of traders at the Royal Bank of Canada, led by Brad Katsuyama, felt the market was rigged. They saw their orders getting picked off by faster players. As famously documented in Michael Lewis's book, Flash Boys, they discovered that high-speed traders were using superior technology and proximity to exchange servers to front-run their orders in milliseconds. Their solution wasn't another dark pool. It was a new, lit exchange. They founded IEX in 2012, which became a national exchange in 2016. Its signature innovation? A 350 microsecond speed bump, a tiny intentional delay created by a long coil of fiber optic cable designed to level the playing field and blunt the edge of the fastest predators. It was a market design born directly from the dark pool wars. Nothing reveals market structure like a crisis. During the meme stock mania of early 2021, as retail trading in stocks like GameStop surged to unprecedented levels, the system was pushed to its limit. Off-exchange trading volume spiked into the high 40%. While the public, lit markets looked chaotic, thin, and impossibly volatile, with trading halts and massive price swings, the wholesalers behind the scenes were executing a fire hose of retail orders. In a way, the off-exchange world acted as a shock absorber. But it also highlighted how, under stress, liquidity doesn't just vanish. It flees the public square and moves into the private alleys. This brings us to the central trade-off. Lit markets perform a vital public service: price discovery. By displaying all the bids and offers, they create a reliable, transparent price for everyone to see. Dark pools and internalizers are, in a sense, parasites on this process. They use the public price as a free reference to conduct their private business, without contributing their own orders to the public book. The paradox is this: if too much volume moves into the dark, the public quotes can become thin and less reliable. The spreads can widen. The very price signal that the dark venues depend on for their existence can degrade. The shadow needs the light to exist. But if the shadow grows too large, it can extinguish the light. This is not a static system, it's a perpetual cat-and-mouse game. From Instanet's first electronic whispers, to LiquidNet's block matching, to the rise of wholesalers and the rebellion of IEX, each era invents a new way to manage the eternal problem of information leakage and market impact. Regulators chase behind, trying to balance fairness and innovation. Then, technology and incentives find a new loophole, a new side door, and the entire structure adapts once again. The game never ends, it just moves to a new table. So, what's the one big takeaway? In markets, price is just a number. The real currency is information. The price you see on the screen is a signal, but the volume you don't see is the strategy. Understanding that nearly half the market operates in this parallel, hidden dimension is the key to understanding why prices can suddenly gap, why liquidity can seem to vanish, and why the tape is telling you a story that has already ended. The lit market is the headline, the dark market is the fine print, and a smart reader always checks the fine print. If you appreciate learning about the hidden plumbing that makes markets tick, subscribe to Ticker Lore and let us know with a like. We stick to the mechanics, never advice, to show you how the machine really works. There is more to come on bubbles, crashes, and the forces that truly move prices. See you in the next one.